Always your favorite chartered accountant, Samuel Oluwole is my name. Why not go grab a cup of wine and let us have fun together with accounting. Okay. Today, we will be looking at what we call accounting equation, a very popular topic in accounting in business. You always have to deal with this. You always have to. Accounting equation. Now, you will agree with me that equation is something like this. This is the sign for equation. Equation. Which means that there are two sides in that equation, and whatever you have on this side must be equal to what you have on this side. That is the first meaning of equation. I'm starting this way because I hate to cram. I don't cram anything, and I don't want students or people to cram wherever they're learning. Because anything you cram, I give you 1 month, it's going to just off your head. So the equation sign implies that what you have on the left side must always be equal to what you have on the right hand side. The two of them must always be equal. Then in accounting we say the equation is that A must be equal. Just look at it, it's very simple. A must be equal to P plus L. That is your accounting equation. That is, when you add P plus L together, you must get A. So the next thing is, let us see what is the meaning of A. A represents assets, A represents assets, which must be equal to equation sign. Don't forget, which must be equal to E. In this case, is equity plus L represents liabilities. That is your simple accounting equation. Assets equals equity plus liabilities. Assets equals equity plus liabilities. You see, this accounting equation goes far beyond what you're seeing on the board here. It goes far beyond. First, I'd like to quickly talk about why the accounting equation. Source of accounting equation. Why is it that we have two sides in the accounting equation, and why is it that the two sides must be equal? I draw my answer from what you know as the double entry principle of accounting. That was the topic we looked at in lesson 1. The double entry principle, as a reminder, says that you are creating two entries from one transaction. That is also what you call the dual concept of accounting. Two entries. So you will debit one entry and you will credit the other entry. That's what you do throughout in your journal entries and also in your ledger accounts. You debit some item somewhere, you credit some somewhere. So accounting, by its basis, is looking at two aspects always. There is a side and there is another side. And this is even the debit side and this is the credit side. So from the double entry principle, we have created double sides. Some entries are falling on the debit side, some are falling on the credit side. And now accounting equation is now reminding you that having done all your postings, at the end of the day, all what you have on this side must be equal to what you have on this side. And that's where you say your account as balanced. Okay. So that is it. Assets equals equity plus liability. So when you add your liability and equity together, which is capital, this is capital, you always must get your answer as assets. Remember that in lesson 1 and lesson 2, I let out the secret to you and told you that technically, equity and liabilities, they have a common effect on the accounts and they move together and they are always on the same side. Can you see another confirmation here in your accounting equation? So now the question I want to ask you, you see, accounting is not a course that you just do and you say no, you don't know. One of the core qualities of accountants, that's what people tell me when they get to meet me in the course of work. Say, hey guy, your attention to details is second to none, because accounting is all about attention to details. So, what I was saying, just look at it, think for a second, okay? Pause and think for a second. Why am I to add my equity to my liabilities? Why are you adding? You are adding because technically the two of them, they have the same effect and they are always on the same side. So when you add your capital plus your liabilities, you're down to your assets at the end of the day. That is what you have. That is what you have. So let us see how the accounting equation works. Let us see something, one more thing. Now, another thing you have to consider is that the accounting equation is the bedrock of every single thing that you do in your balance sheet. As a student, you have to know this. As a business owner, it is what you have to know. That in your balance sheet, what you have there is an expression of accounting equation. I want to show you something. It baffles me a lot when I see students, people cramming accounting and they say accounting is a tough course. I say, are you sure it's accounting you're learning? This is fun, this is easy, this is super simple. Come on. The balance sheet. We are going to have topics dedicated, we are going to have lessons dedicated to balance sheet. What balance sheet is, what are the components, why the balance sheet, the functionality of balance sheet, how to prepare the balance sheet, what are the items in the balance sheet, and how do you get to balance your balance sheet at all times. But for now, you're going to know one thing about the balance sheet. The balance sheet is simply a statement of financial position in your business. It is also a statement of assets and liabilities. So these are the assets you're having in the business and your liabilities. So we say the balance sheet is a statement of assets and liabilities. And now I'm going to tell you this. Accounting equation is the basis upon which your balance sheet flows. That's the connection. Because accounting equation says assets must be equal to capital plus liabilities. And why do you not prepare your balance sheet? You want to test what the accounting equation has said. So basically, I want to show you that these are the items you have in your balance sheet. There are only 3 items on the balance sheet. As opposed to what students are misled to understand that, there are a lot of items that will come in: motor van, office equipment, plant and machinery, inventories, debtors, payables, payments, prepayments, accruals, cash and bank, equity, short-term liabilities, long-term liabilities, loan note debentures, and all of that. Those are long story. The short form of it is there are only 3 items in any balance sheet to the end of the world. In this case, you are not learning by cramming, but you are learning by understanding absolutely the key principles that uphold the profession of accounting. So, if you give me, in my years of experience, I'll say that I have prepared well over 1,000 balance sheets. So, when I talk about balance sheet, just listen to me, okay? It doesn't matter the size of the company, small or big, to the end of the world, there will always be only 3 items in your balance sheet, just 3 items. And that is coming from your accounting equation. 1, your balance sheet is going to reveal assets. Here, I want to use the conventional format, okay? So let me use the conventional format. You have assets on the right side, and it is also going to reveal on this side, the left side, is going to show your capital plus a what? Plus liabilities. It's very simple. This is what accounting equation is saying. And this is why your balance sheet must always be balanced at all times. And so, if you prepare your balance sheet and this side is not the same as this side, we say that there is an error. Because the accounting equation insists that assets, which is total asset, must be equal to what you get after adding your capital to all your liabilities. So 3 items. But we'll look at this in future lessons. That's what we're focusing on. Now, when you say assets, you can now talk about numerous examples of assets in the business, which you get to list down here: the fixed asset, the current asset, you have the lease. So the total you get here, let's say you have $100,000 here, must also be $100,000 here. So in this case, you have your capital, your equity in the business, to all the liabilities, the debt that the business is owing. Then you have this total being equal to that. Look at it once more in the balance sheet. Capital and the equity and liabilities are still on the same side and they are added to each other. Don't forget, I told you, they have the same technical effect on the financial statements. It doesn't matter whether you love that or you don't, but it will always be.